It's time for the market update.
So today we want to look at the market heading into September, Bill. We had a little bit of positive movement in terms of interest rates, kind of pulling back a little bit. But as of this recording, we are back up towards the high we've seen the last year, and really well beyond that, right over 7% again.
Yeah, so as of right now, a 30-year fixed rate mortgage is over 7%, maybe 7.375 is right about where the rates are. So they did come back down to 6.375 about 6 months ago. And, when we look at interest rates and we look at a lot of these forecasts, we were forecasting rates to be lower right now than where they are. And everybody's thought, and when I say everybody, I'm talking about some pretty renowned economists saying that the inflation numbers would start to cool a bit, and they actually have. So that's good news. The Fed's policy, where they have rates, the federal funds rate is, it was at 0 in February of 2022. It's at 5.5%. So it's gone up 5.5% in, a year and a half. And the Fed considers this policy to be restrictive, which is good. They're trying to restrict growth. They're trying to cool things down to slow inflation. And now their stance is more of, well, we don't know that we're going to raise anymore, but we're going to hold here for a while. So the problem, though, is that there's things that are unforeseen. So, the war in the Ukraine has certainly affected markets. And then the regional bank crisis, if you look at some of the charts and you look at where rates spiked, you can see definite correlation. So I feel like without those two events, we'd be in a better spot, right? Rates would have already come down a bit. But the other thing is that the Fed and a lot of economists thought that the labor market would have cooled by now, and it has not. So our economy is still very strong. And I feel like until there's, a break in the labor market where, the unemployment rate gets a little bit higher due to this restrictive Fed policy, and some of the other, forces that we need to see come into play, we're going to be here for a minute. I feel like we're at an inflection point, like 7. I don't see rates going to 9%.
Okay.
And this is, again, based on a lot of information that we've collected and that we read, based on, economists that, and advisors that we subscribe to. So I feel like we could be here for a little bit. I don't think they're going to 9%. I do think you'll see rates come down in 2024. So we just got to hang on a little bit.
Hang on. That's been the story for a lot of people, I think, not just in real estate, but all different aspects of the economy right now. It's just kind of hang on and survive and move forward. But I'm curious kind of what your meetings have been like with people right now. It's just a lot of asking about, hey, what's lying ahead? There's not a lot of supply out there. So, I'm curious kind of what people are asking and kind of where their mind is heading into meetings with you.
So that's a great question. So we're always trying to understand what are the short term, the midterm, the long term goals, both for the house and for their overall financial picture. And we feel like if somebody's buying a house and they feel like they're going to be there for a year, that's a scenario where you really need to have a good reason to do that might be outside of any economic reasons, because you're going to pay closing costs to buy and sell. You may see additional upside that we've seen in this market, but what if the market cools off? And all markets tend to cool off at some point, right? So that's not giving you a lot of runway or time in that house. So if your time horizon is 10 years that you're going to be in the house, it makes sense that, because people are saying, I'm waiting for prices to fall and rates to fall. Well, there have been people that have been waiting a few years for that now, and it's not happened. If you're going to be in the house for a while, you're going to have a chance to refinance. We feel like there's a really good opportunity that you'll be able to refinance. So those are the kind of conversations that we're having. And the other thing too, Ben, is when we talk about, interest rates being high, that's not such a great thing in my world, but that does mean that the economy is doing good, that our country is doing good, that the U.S. came out of COVID and the U.S. economically has done better than any other country in the world. So although when it comes to buying houses and mortgage rates, we want the rates to come down, of course, having a very low unemployment rate and lots of job growth and lots of job openings and good pay for all is still a really great thing. So we got to make sure we shed that light on things.
We talked about that discussion about, economically, does it make sense when you're looking at time frame and stuff? I'm curious on the refinance side, because you mentioned the rates dipped down about 6.375, I think is what you said. At what point is it worth considering a refinance? So if you get in a home now, is it worth it if you get locked in at 7.3 to when it falls to 6.3, 7.5 again to lock it in there? Because I'm sure some people are going, oh man, I wish I would have considered that 3 months ago when it happened.
So there's not a set number as far as, if you listen to some of the more popular talk shows or folks, they'll say you have to go down 1% in rate. Well, on a $2 million loan amount, 0.25% would move the needle. On a $50,000 loan amount, 3% might not be enough. So it's all going to be customized towards each individual borrower. How much do they owe? How far are we into the amortization schedule? And then what's the cost of the refi and what is the time frame to recuperate the money so you get to a break even? So and I've seen this famously with a lot of the, internet lenders. Sorry guys, I pick on you guys a lot, but I do see this where it's like, hey, you're only going to save $20 a month. Your break even's 10 years from now. Well, most people don't even keep a loan for 10 years. You might not even be in the house in 10 years. If you're there in 10 years with the time value of money, that $20 savings is now $7. And I feel like that's the point where you say, don't do anything. We need a better rate. Don't let anybody tell you to do anything. So what we usually do is we do an analysis. We'll work up a loan estimate. We'll put it all in writing. What are the costs? What are the savings? Look at the whole picture. What are your plans? Hey, we're saving $400 a month, but I'm moving in 6 months. It's not worth it. Don't do anything. And believe it or not, we have these conversations. And I think it's good that people reach out with those questions because they're looking to be proactive and save money where they can. But I think by and large, we look for a break even between 2 to 3 years. If your closing costs are paid back within 2 to 3 years, that's a good number. That could be 0.75% lower rate. That could be 1%. It could be 1.5%. So we need to work out the numbers to your specific scenario, plug it all in, see where it puts us.
But I guess to kind of wrap up this conversation, if it drops 1%, it's worth having a conversation just to run some numbers.
If anybody sees the rates come down 1%, they should absolutely reach out to their mortgage lender to see what can be done. If anything, it's worth the call.
Okay. Might not work out for you at the moment, but it's worth having that conversation. So if you want to have a conversation with Bill or over Cross Country Mortgage, the best thing to do is either to log on, smartmortgageshow.com. Plenty of great resources there for you to help you with that mortgage process. But also, you can call 484-352-4151 for Cross Country Mortgage.